Strategas is head of technical and macro research. Chris Verrone is here at Post 9 with some answers. So what do you think? I mean, I know you track the charts, but I mean, the Fed factors into the fundamental story here,
I think the market agrees with Waller here. When you look at the weakness we've seen on a relative basis in consumer discretionary, we've seen cyclicals weaken relative to defensive. So if we're going to use the market as our gauge to how the economy is perceived here, I think there's certainly been a change in character over the last 2 or 3 months. You know, we've talked about it, you as well, with healthcare turning up, with the utilities really assuming their leadership. So there's certainly a more defensive streak. We're sitting here with the 2-year yield roughly 355, 360. I mean, that's still 2 cuts below where the policy rate is. So our view is the Fed better get on board here because you're getting the messages of a weakened economy through the lens of discretionary, through the subtle turn of improvement in staples and utilities and healthcare.
Why has the long end, though, been backing up?
Yeah, I think that's the tricky part of the call here. When you look at 30-year yields, they've backed up modestly since the last Fed meeting.
Well, we were under 4% on the 10-year, don't forget.
Yeah, and 10s have rallied 420. I would be very surprised if we saw 10s much above 430, 435 in this environment. To me, that's the top end of the range. I'm a buyer of bonds there. I think ultimately the Fed will have to cut. It's a question of whether the bond market forces it sooner and more aggressive than they would like.
What are we trying to figure out? I asked this question 43 minutes ago at the top of the program. Like, what's the market caught between here?
I think the market's caught between 2 things. Is this simply a flush of weak hands in crowded AI beta positioning, or is it a fundamental rethink of the shape of the economy? I still want to give the benefit of the doubt to this market. We're in an uptrend. Leadership has generally been pretty good all year. I don't think the breadth or the internals are as bad as advertised. But I wonder if we need some type of a flush to wake up the Fed. And, you know, we undercut, or we're about to undercut that, call it, 6640 level here on S&P. Underneath that, there's really not much till about 6450. So do you need that oversold condition to really wake up the Fed into the December meeting? That would be my suspicion.
How do you feel about the role that NVIDIA could play one way or the other?
Yeah, it's funny. It's not, believe it or not, it's not NVIDIA or the semis I'm particularly worried about. Those aren't top formations. Those are stocks that are up a lot that might need to consolidate or correct. What I'm worried about is the names that have actually been putting in big distributive top formations in tech over the course of the year. Look at legacy software. Look at Salesforce. Look at Workday. Look at ServiceNow. Those are the ones where if NVIDIA falters here, I want to be very, very careful I don't own any of the real weak top formations.
But I mean, some of those hadn't participated anyway. Like Salesforce is not. Let's throw that up again, guys, please. Look at year-to-date, Salesforce. It's not like you had some massive run-up you got to be worried about. These guys have been left out in the cold.
That's the point. If the good stuff starts to falter, it's the bad stuff that really bears all the weakness. Take financials as an example. The banks have been the best in the sector all year. What has been weak? Private capital, alternative asset managers. If the banks begin to falter here, it's not banks I want to short. It's the Apollos and the Blackstones that I think
they're already down a lot.
Yeah, I think all the big mistakes in this business happen trying to catch bottoms or trying to catch calls in big tops. Those private capital stocks are weak across the board here. I think it's another message that the Fed ought to heed.